Hello, and thank you for joining us. I'm Matt Booton, an independent financial planner at KLO Financial Services. We're proud to work with some of the best industry names in terms of investment managers, funds, and providers for the benefit of our clients. We also like to give a platform to industry specialists to communicate directly with our followers and clients. Massimo Varni is our dedicated investment analyst at KLO. He spends much of his time analysing investment options that are independently available to our clients. Where required, we seek to incorporate some of the best-in-class responsible investment solutions within our client portfolios. Today, we're especially pleased to welcome Will Argent, fund manager at Gravis Captial. Will is responsible for the oversight of the VT Gravis Clean Energy Fund. Will, can you please explain the strategy of the fund and how it's positioned for the current market cycle?
Yes, hi Matt, thanks for the opportunity to speak today. Certainly, the strategy is aimed to provide exposure to companies that are engaged in the generation of low carbon and clean energy, with additional scope to access companies that are involved in the broader decarbonisation theme and energy efficiency solutions. I must make clear that our investment strategy is focused on accessing physical energy infrastructure. So the companies we own will themselves own and operate things like wind farms, solar parks, hydroelectric assets that all typically attract very long-dated, resilient revenue streams, which underpin our objective, which is to deliver a very attractive and resilient yield, and also scope to deliver some capital growth over time. We typically invest in companies that are listed in North America, so Canada and the US, Europe, the UK, and also Australasia. But the underlying assets may also be located in other jurisdictions. Now, it's a thematic strategy, so our primary focus is unlikely to sort of alter through market cycles. I think generally we remain in a world where reliable, attractive levels of income are scarce. So in that regard, I think we're quite well positioned to provide a good solution. We also believe that the fund is exposed to what we see as a very long-term structural growth trend. The energy transition and that decarbonisation agenda is a very long-term dynamic. And of course, electricity and energy is a critical service. Cash flows are highly contracted. And as such, we see good prospects for the strategy to sort of navigate through different stages of a typical market cycle.
That's great, Will. Thanks very much. Are you able to provide us with a couple of examples in terms of stock selection and how they fit into the clean energy mandate of the fund?
Yes, certainly. So I think I'll start with a company called Brookfield Renewables, which is a very large $15 billion market cap entity listed in New York and Toronto. Brookfield owns a very large, diversified renewable power platform. So it owns assets including hydroelectric assets, wind farms, solar parks, and some energy storage assets, with a total capacity of over 20 gigawatts, which is very considerable. Now, that underlying asset base is underpinned by very long-term contracted cash flows. The output that's produced from these assets is sold to very high-quality off-takers who use the power that is produced. Now, that company's done very well. It's a really good example of a core kind of position within the portfolio. It's done very well over recent times, such that the yield has contracted down to around 3%. However, the company's ambition is to grow its distributions in the region of 5 to 9% per annum, within a broader context of mid-teens total return objectives. So, it's a really good example of a core name within our strategy, and many companies like Brookfield make up the core of the strategy. Now, as a second example, something a little bit more peripheral to the strategy, but important nonetheless. I'm going to pick on a company called Gresham House Energy Storage, which is listed in London, actually. Now, Gresham House Energy Storage owns a portfolio of utility scale battery storage assets. So these are sort of critical infrastructure, ancillary infrastructure that's required, to be able to harness the increased penetration of renewable energy generation on the grid. Of course, things like wind and solar are very intermittent, and so there needs to be solutions in place to address supply imbalances that result and are going to sort of increase in frequency as more renewables penetrate the electricity supply mix. So Gresham House Energy Storage asset base is located in the UK. They have a portfolio of operational battery storage assets. There's considerable scope for growth in the UK. The system operator, National Grid, believes there's scope to have around 13 gigawatts of capacity in place by 2030. That would be roughly a tenfold increase on where we started 2021, for example. And companies like Gresham House that own these storage assets, they actually benefit from periods of higher volatility in power prices. And so they complement our core position in companies that are exposed to power prices. So it's quite a nice diversification in the context of the portfolio.
Excellent. So in light of COP26, which is obviously very topical at the moment, Will, how confident are you of any risk of greenwashing is well managed within the fund?
Yeah, that's a good question. And I mean, firstly, I'd say that the fund itself doesn't really make any claims about greenwashing per se. All the companies held within the portfolio are directly involved in the energy transition. The focus on that physical infrastructure means that the vast majority of the portfolio is invested in companies that are owning things like wind farms and solar parks and other low carbon energy generation assets. And they make the revenues from selling the output that is produced. Now, in as much as greenwashing is the kind of process of conveying a false impression, providing misleading information about how sustainable or environmentally sound a company's products are. I really don't see much risk in our portfolio that any of the companies are trying to exaggerate their credentials in that regard. But I mean, as with any industry, there are still environmental negatives from constructing, operating and decommissioning a wind farm, for example. So, that is just a fact, I think. What I think investors might be keen to hear about is that the fund is managed in adherence with a responsible investment statement. Now, this statement details the exposures that may or may not be permissible within the fund. And so, for example, we do allow some exposure to natural gas within the portfolio. However, power generation from nuclear and certainly from coal is simply not, completely ruled out of the portfolio. So, on top of that, our companies are analysed by an independent third party purely in respect of that responsible investment statement. So there is a level of oversight and third party input as to whether our portfolio companies are in adherence, are in line with our commitments.
Excellent. And finally, does investing in clean energy will make sense in terms of getting a financial return for your money?
Yes, another good question. I think there are different ways to invest in clean energy, and as I've hopefully articulated, our focus and our approach is to target the sort of renewable energy infrastructure space. Long dated, contracted cash flows from companies that own wind farms, solar parks, and these types of power generation assets. These companies have really good visibility over their future cash flows over the long term, and of course they're providing a critical service. powering homes and industry. And of course, they're focused on growing their contracted asset bases to drive growth in cash flows over time. But the principal return from our strategy is really meant to be the income side of things. Now, the fund itself has delivered a total return of about 77.8% since inception. That equates to a compound annual growth rate of around 16%. So I think that's been probably ahead of our expectations. I think investors are pleased with that type of return, and certainly on a risk-adjusted basis, returns are even more attractive. But I must say, ours is just one strategy or approach. There are other ways to invest in clean energy, as I alluded to. So, there are other ways to invest, maybe with a focus on companies in the supply chain that are, really stand to benefit from just growth in demand for components, for example, or disruptive clean tech. There are lots of companies trying to gain competitive edges in sort of hydrogen tech, fuel cell tech, and things like this. That's not our approach, but there are a range of ways investors can get access to this general theme. So I think the answer to the question is yes. It does make sense from getting a financial return. But I think investors need to appreciate there are different ways to approach it with different risk-reward characteristics and expectations. And as such, investors must select an investment approach that really suits their personal objectives, appetite for risk, and so on.
Excellent. Will, thanks very much for your time, and I really appreciate your thorough answers to the questions. It's really appreciated. Thank you to anybody watching. We really hope you've enjoyed the content and found it useful and informative. If you want any more information about responsible investing at KLO Financial Services, please feel free to contact us. We'd be delighted to hear from you. Thanks very much.